Hi everyone. As Peter said, my name's Ryan Weeks. I'm the Fintech correspondent at Financial News, which is part of Dow Jones, and I'm joined by Rishi, who's been introduced. Rishi, I'm sure most people here know a fair bit about Oak North already and what you do, but perhaps you could give a very brief summary of the business. There are sort of two main bits to what you do, and there's the lending and then the technology as a second piece. Maybe you could give a brief introduction.
I view it as one bit, but let me sort of give a 2-minute backstory to put it into context. So the original seed of the idea of setting up Oak North really came while we were building our previous business. As Peter mentioned, we started that with very little capital, built it all the way through with actually that £40,000. But in 2005, as we were building it, we said it'd be really nice to have a line of credit from a commercial bank in case we get a delayed payment from a customer. We've got more than like 2-3 weeks working capital because that's what we're balancing on at that point in time. Went to one commercial bank, were politely shown the door. Went to another one, we were told where to go. And then a few months later, we got in front of the special sits group, the prop trading desk of one of our clients, Citibank. And when they could take an institutional approach to analyzing our business, they actually did a $10 million dividend recap for us. So it was a stark contrast where we couldn't get a few $100K from two commercial banks, but we could get 10 mil from a institutional player. So that was in 2005. We built that business, sold it in 2014, and as we were selling it, we kept coming back to this issue. And we sort of figured that there is a whole gap within the market where companies are continued to be treated as retail plus customers when actually their needs are much more corporate institutional in need. And therefore, we said if we can actually build a platform to be able to take that institutional approach to underwriting and monitoring and apply it to smaller businesses, we can probably serve a large part of the underserved community of SMEs, and really those SMEs being those which are already somewhat proven out in growth mode. So that's what Oak North is about, and the platform is key. We've played it out in the UK with our own bank to prove the model, and the same platform is what we license to banks across the world.
And you've been able to build the loan book extremely quickly to, I think, in the region of £3 or £4 billion now. Is that about right?
Just over £3 billion today.
What's been the key to being able to do that? Because I believe you launched in about 2015, so it really is, a very small amount of time that you've been in the market. Right.
So September 2015 is when we launched. So we're pretty much 4 years into building the business. And I would say we're around six times our original business plan today compared to where we thought we'd be. And if you look at sort of what's driven that, it's very much a pent-up demand within a community which just is, as I say, meaningfully underserved, which has driven that growth and clearly our ability to somewhat address that.
And despite that rapid initial growth, are you still growing in terms of loan dispersals?
Every single day.
Right, right. And this is a niche, isn't it, that sort of the banks have largely retreated from, mainstream banks, but also that fintechs aren't really serving either. Fintechs are mostly that are in the small business lending market, mostly towards the smaller end of the small business lending market. So how have you been able to address the needs of these customers where others seemingly have not been able to?
So here's the really interesting thing. So if we take those two contingents, so you take other commercial banks or commercial banks and then you take pure fintechs, with commercial banks, I would actually say that commercial banks were really good at serving this segment. If you go back probably 3 decades ago, you go back to the 70s, 80s. I mean, I remember in the 80s sitting with my father in his business and having the bank manager actually come down, being able to analyze numbers, create a forward-looking view, make a credit decision, etc. That's been taken out of the system through the 90s, 2000s, and through to today with centralized credit decisioning models which treat those customers as retail customers. So what we're doing is we're enabling those customers to be treated back to where they were in the 70s, 80s, but with much stronger risk management. So I would say those customers are still being served, but they're just being served as Retail Plus customers rather than as they should or as they need to be. In terms of fintechs, one of the big challenges in this area is actually taking the institutional corporate approach to underwriting and monitoring is immensely complex versus a scorecard approach, which is built up on some type of equivalent of an Experian or FICO score model. So the scoring model and adding to that other behavioral aspects is in a way more natural and still not easy because of where are the correlations and what's a true signal, etc. Outside of, as I said, outside pure calibration of credit ratings. But if you go to the institutional approach and you try to break down all the activities which are taken in analyzing a business and how different they are across subsectors and apply technology to that, again, I don't think we would have been able to do this if we hadn't spent, from 2002, sort of building through and learning about research process at the institutional level.
What those banks in the 80s that you mentioned didn't have is technology, and you mentioned the application of technology there. But let's drill into that a little bit more, because these are customers that are pretty large, and a lot of your lending is secured. So there is definitely still a large degree of what you do involves going and kicking the tires, as they say. What would you say is the split? Where are you using technology? How does it all sort of fit together?
Yep, this is super interesting. So I think whereas a lot of fintech businesses
trade secrets.
There we go. Whereas a lot of fintech businesses have focused massively on, we lost the mic.
Can we hear?
Are we good? Yeah, that's what I thought. Thank you. Okay, so whereas a lot of fintech businesses have focused on making the interaction with the customer 100% digital and actually being willing to do a lot of manual work in the background, what we've done is almost flip that, where the interaction with our customers tends to be driven very much by, at least in the UK lending business, by relationship managers. And those relationship managers still interact with customers in a very traditional manner. However, the technology in the background enables them to do something like 5 times the number of transactions they would otherwise do in a normal environment. So what we've said is that when a borrowing customer is looking to take 5, 10, 15 million in lending, they want to have that personal touch. And from a lending perspective, you need to kick the tires on loans that size. So our view is you bring the efficiency internally, and then that's why the product works so well when we go to clients, other banks outside the UK to license the platform, because what you're doing is you're putting the technology in to add significant leverage, i.e. enablement, increase in efficiency, productivity to their existing teams, rather than saying that actually this is a totally new way to service your customers, which, by the way, most customers are actually anti, especially when you're looking to borrow those types of sums of money.
So it's largely about sort of efficiency and filtering human attention. What about data? You know, are there sort of data sources that you've tapped into that you feel that other players in the market are perhaps missing? I'm sure you're limited somewhat in what you can say about that, but.
I mean, look, I think there are 2 or 3 things. So taking a technology-driven approach allows you, number one, to go to many more data sources than you otherwise would. So on a lending case, a traditional bank probably won't even go to external data sources. If they do, they may go to 1 or 2 data sources. On a lot of the credits that get analyzed, there may be 20 or 30 data sources which go into developing analysis on a single credit. So number one, a much larger number, again, driven by the tech-driven approach. I think the other aspect is that we're clearly gathering data as we do more and more credits, and we monitor the credits on a regular basis, either monthly or quarterly, so you get time series of information as well. So the data sets internally also continue to build.
Okay. And you know, this is clearly a profitable niche because Oak North has been able to generate quite substantial profits in the past 2 years at least, perhaps 3?
We hit cash flow break even in 11 months.
Right. Okay. So and why is that? You know, why is there such an opportunity to lend profitably to these sorts of businesses that are perhaps, you know, more towards the M of SME?
So look, I'm a traditionalist. I think all businesses should make money. If there's an opportunity to build a profitable business, I sort of question why be in business. But clearly there are business models out there which differ with that. So in my view, you've got a customer need because you've got a customer segment which is significantly underserved. That segment is meaningfully large. That customer segment is willing to pay sensible economics to enable a sensible business to be built.
Okay.
Simple.
Right. Okay. And the loan book itself is relatively young. What proportion of the capital that you've lent out to date would you say has been repaid?
So really simple numbers. We've lent a total of about £4 billion, and we've had about £1 billion repaid. Average term is about 3 years. So you can see how it sort of plays through.
And one of the things that's often quoted is not a single default to date. Is that still the case?
We've had one default. We've had no losses.
So the one default is new. Sorry to hear it.
Somewhat inevitable.
Yes. And so I was going to ask next about sustainability, in fact. And you know, I'm sure as all firms do, you have one eye on the possibility of a recession. How do you plan for that? And you know, what are you doing to ensure that the growth that you've seen and that the sort of the accuracy, if you will, of your pricing, how do you ensure that's all sustainable?
So we've got a lot of focus in terms of market cycles generally. Again, when you take an institutional approach to underwriting, you're always thinking about what does the recessionary case look like, and on a general basis, you look through 2 business cycles. Obviously, given that the last business cycle was more extreme than one we've had in living memory, we use that to actually stress test each individual credit which gets written by the platform. So given that's inbuilt in the process that we have, when you aggregate that across the book, it's very clear and very easy to be able to see what the impact should be, right? Obviously, the impact will be tested through a cycle, and I totally accept that. I think I'm very confident to say that given that we've gone through a granular approach on each individual credit and then on a portfolio down approach to actually have a look at the overall impact across a portfolio, we will perform meaningfully better than market in terms of how we'll weather a recessionary environment. And ultimately, like any entrepreneur, you sort of see opportunity when there is a downturn.
And just before we come on to the tech product, you've raised a lot of money to date. Is part of that with
a modest amount?
Yeah, a modest amount. Well, it's in the billions, is it not? Yeah.
Circa.
Yeah. And is part of that with an eye on the possibility of a downturn? I know a lot of fintech founders say you raise when you can because those pools of capital might dry up, and you don't know when that might happen.
So to be clear, I think I fully agree with that. You raise money when you don't need it, not when you need it, because ultimately, if you raise money when you need it, you're always on your back foot. So that's absolutely true. Obviously, given that we are a profitable business, it's sort of raising additional capital is somewhat, how can I put it? Like last round we did, a lot of it was buffer, rather than actually saying we need the capital because we're burning capital. So we're in somewhat of a fortunate position because of that. But yes, do I think you should raise money in good times? Absolutely.
And could we just, so coming on to the sort of the almost software as a service product that you have, could we just do a quick overview? I know you have a few partners you can disclose. NIBC is one, and I think geographically you can say something about where your customers are concentrated as well.
US, Europe, Asia.
US, Europe, Asia, okay. And any others that you can disclose beyond NIBC?
No, I mean, we can't disclose any others at the moment, but suffice to say that we have many banks in each of those regions who are currently live with us.
Right. And I've heard that Asia and China more specifically is a region where you are finding a good deal of success. Is that true?
Yeah, so absolutely, we've got an operation in Shanghai as well, servicing local market, and therefore, I mean, China is absolutely a priority market for us.
What has it been like to navigate that market for it? You don't see a lot of UK fintech firms expanding to China. Tandem is one other that I can think of, but there aren't many. What's it been like to navigate that process?
So the thing, I mean, look, in my previous business, we had a couple hundred people in Beijing, and therefore we've operated in China. It's probably since 2006 or 2007. So we have some experience of actually being able to work in, like any market, every market has its idiosyncrasies. So the figuring out how to actually launch Oak North in China and make it successful in China has been less of a learning curve than it would have been clearly if we were entering the market cold. But at the same time, there are always learnings because clearly from a data perspective, et cetera, China has to keep everything within borders, which just adds complexity.
And how do you operate this kind of business model without effectively sort of arming your competitors? Because, so one prominent example that springs to mind is OnDeck, the US small business lender, obviously a different market, but they worked for a long time with JP Morgan. And then, quite suddenly, seemingly earlier this year, that partnership was pulled, and JP Morgan are going to go away and develop it themselves, develop a similar product themselves. So how do you do this without making it such that, you're almost being sort of anti-competitive?
So it's an interesting question. So if you look at, again, and I'm not going to necessarily use that example, but if you look at sort of an automated retail or small business lending approach, which is based, like I said, on sort of credit rating agency calibration plus some other signaling data, you sort of look at that and you say, how hard is it to actually replicate? How hard is that to build through? And clearly you have banks making the decision that they want to do that in-house. And clearly you've had a lot of banks which have started building businesses within that space from scratch without actually having ever gone to a vendor. I think, again, it goes back to the complexity of the problem which we're solving, i.e. taking that institutional approach and applying it down market, which actually creates a much tougher barrier or a larger barrier for those organizations to be able to go and copy what we're doing. And then the data sets which we're building internally clearly are an aggregation of anonymized data from lots of clients. And therefore, any one bank is not going to be able to replicate that with their own data. Okay.
And the tech part of the business itself, is it called Oak North Analytical Intelligence or just?
Yes.
Yes. So is that now contributing significantly to revenues? I know probably due to the sensitivity of your partners that you're a bit limited in what you can say, but is it a significant contributor?
So I won't answer your question.
Right.
What I will say is that if you look at total assets on the platform, we're about $10.6 billion, of which the UK business, our UK business, is clearly at £3 billion.
So just to be clear, so that's 10.6 billion that product is sort of advising.
10.6 billion of assets which are on the platform, so therefore loans which are being processed through the platform.
Right.
Of which just under $4 billion is our UK book,
right.
And the rest is all third party.
But it is certainly a significant contributor to the valuations that you were able to achieve in the various fundraising rounds and with Softbank. Is it something that Softbank particularly prized? And can you talk a bit about how they, everybody knows the stories about Softbank coming in and you saying what you're looking to do and them telling you, well, you have to do it 10 times as large as this. Can you give us a bit of an insight into that process and specifically how it applied to the technology part of the business?
Sure. So look, I think that the experience with Softbank was somewhat like you say. So you sort of have the conversation and they say if you take capital off the table as a constraint. Just how fast, how large, et cetera, can you grow this business? And what does it look like? And to be clear, before we meaningfully engaged with Softbank, we were already fully funded as a business. And having that conversation, you know what, it's eye-opening, because you sort of say, okay, if you take all constraints off, how fast can you go? How large can this be, et cetera? And then you need to balance that through with fast is great, but if you're going to risk the franchise over, I don't know, leapfrogging 12 or 18 months, is that actually worth it, right? So you need to moderate fast with actually robust. So we've kept to a plan which, in our view, enables us to grow in a very robust manner, but actually reach higher scale than, let's say, where our ambition was prior to engaging with Softbank. So I'd say from that perspective, it was a very positive process and exercise with them. Yeah.
I have plenty more questions, but I know Peter is desperate to give the audience their chance. We've got a couple on the screen there. I'll just read them out so people get. So the data sets are so different between countries. How are you presumably able to replicate your tech across geographies?
So fully agree, the data sets are very different across countries, and granularity of data available is also meaningfully different across countries. So that's exactly why there is so much of a challenge to actually making the model scale across countries. Today we're probably operating in 9 or 10 different countries. However, when you look at the technology is driven a lot by what are the industry drivers, and what are the parameters which matter for a sub-industry group. Those are pretty common across countries. So the pipes are pretty common, but what flows through them has to differ in terms of where you get your data from. So you have to be able to plumb into a lot of different data sources.
Got another one here. How many customers have you asked to leave your platform, which allowed you to avoid a default?
So that's a really interesting question. So obviously I'm going to answer that in context to the UK book. So with the UK book, based on the Oak North platform, we clearly use that to both do the credit analysis, but also monitoring of loans. And the monitoring provides early warning signals. And the early warning signals may be that the number of SKUs or the billable hours have started to trend down in a business, or some other type of issue. So what we typically do is take that, go to the management, put the management information, put the dashboard in front of them, and have a grown-up conversation about sort of, there's an impending issue here which may or may not have hit the financials yet. And we probably had those type of conversations, I don't know, like 15, 20 times. We've only had 2 or 3 situations where the management team have said, no, we don't agree. We actually think everything's great. And when you've got a situation where you've got data which is saying there's a negative trend, and the management's not accepting it's a negative trend and not accepting that they have to do something about it, then with those 2 or 3 situations, we've said, look, it probably makes sense for you to refinance or pay down in some other way, because we don't want to end up having a harder conversation when you have covenant defaults and the like. However, in the large majority, i.e. 80, 90% of the cases, you've actually had management massively appreciate the fact that we've come in forward-footed, actually identified a trend and helped them course correct to avoid a negative position for themselves.
We have one here. What percentage of your UK lending book is development construction finance?
Of our drawn book, circa 30%.
Moving swiftly on, when you say you raise 1 billion, is that pure equity to grow the business or lending across the platform?
So to be clear, we've raised $1 billion, not pounds, and that's pure equity. Clearly, our loan book sits at about £3 billion today. And therefore, clearly, we've financed that using more than just equity, and the financing of our loan book is driven by retail deposits.
Someone has congratulated you on your efficiency and then said, what is the most impactful change that tech provides to impact this speed to underwrite?
It's really the ability to have a thorough analysis of the particular credit with forward-looking views, run through scenarios, to be able to then have a relationship manager and credit professional step back and do the so what, rather than what a lot of relationship managers and credit professionals end up doing at banks, which is chasing the detail and processing credit analysis. And that also, I would argue, predominantly on a backward look basis.
I think that's time up, but maybe as brief an answer as you can manage for that final question, which is, what is the future of SME lending?
With Oak North, it's bright.
Right. Okay, very good. All right, well, if you can put your hands together to thank Rishi, it was a really interesting session. Thank you very much.